Hey guys, welcome to this beginner's guide on investing taxes. Now, if you're new to the channel, I talk about investing in stocks and crypto all the time, but one thing I don't cover as much is how to deal with taxes when investing. More specifically, how to calculate the taxes you owe, strategies on paying less taxes when investing, and yeah, pretty much just everything you need to know about taxes for investors. I simplify everything so it's easy to understand, and by the end of the video, you'll have a lot of useful knowledge that will greatly improve your investing career. Thank you to TurboTax for making this video possible. Let's get started. So first, let's talk about tax efficient investing and why it's so important. Really, the whole thing we're trying to do when investing is to make more money. But when you make money, you're always going to be taxed on it. However, it's great because there are some things we can do to minimize the amount of taxes we're paying. And with that money we save, we can actually use that money to invest further. And of course, that's going to make us even more money. So really the goal is to invest your money in a way that ensures you pay the least amount of taxes possible. And yeah, in this video, I'm going to walk you guys through the most important things you need to know to do that. But first, we need to know how taxes work for different securities. So with investment taxes, we are going to go over how taxes work for stocks in general, taxes on capital gains, taxes on crypto, taxes on dividends and interest, as well as tax loss harvesting and wash sale. Now, first, let's talk about taxes for stocks because this is probably the thing that most of you guys are going to be investing in. I think one thing that a lot of people don't realize is that you actually don't ever have to pay taxes on stocks, right? The only time you're paying taxes on a stock is if you're doing a taxable event, which is something like actually selling it. So if you buy and hold stocks without ever selling it, well, then technically you never have to pay taxes. So yeah, if you buy a stock and the price of it goes up, you don't owe any taxes unless you sell. So for example, let's say you buy 100 shares of Z stock for $50 and then you sell it at $70, right? So we have a profit of $20 per share. In this case, you're basically going to be paying taxes on a $2,000 of profit because we have our $20 of profit per share multiplied by 100 shares that you own. Now, how much you pay in taxes actually depends on several key factors. And the first one is how long you've held that stock for. So really the whole milestone in investing is 1 year. And this is why I like to always encourage people to do long-term investing, because if you hold a stock for over 1 year and then sell it, you're actually going to be subject to long-term capital gains, which, as you'll see, is taxed for most people at a much lower rate than short-term gains. Conversely, if you hold that stock for less than 1 year, so let's say 4 months, and you realize a profit, well, you're going to be taxed at that short-term gains rate, which is basically just as ordinary income. Now, the amount of taxes you're paying can be 0, 15, or 20%, depending on your taxable income as well as your filing status. And I will say that days of holding an investment through options or short sales does not count towards that 1 year. Let's take a look at the 2022 capital gains tax rate thresholds. You can see on the left, we have 0, 15, and 20%. And on the top, we have your filing status. So for this video, let's just look at a single filing status, and you'll see that you'll pay 0% on those capital gains if you make under $41,675. So let's say the income you get from your job is $35,000. You buy a stock and actually sell it and make a $5,000 profit. Well, the good news is that if you held that stock for over 1 year, you're actually going to be paying 0% capital gains tax on it because, like I mentioned earlier, your taxable income is less than that $41,675 cutoff. Now, my guess is that most of you are going to be in the 15% bracket, meaning you make between $41,675 to $459,750. If your taxable income is between there and you buy and sell a stock for a $5,000 profit, you'll be hit with that 15% capital gains. And finally, if you make over $459,750 and you buy and sell a stock for a profit, well, that's when you're going to be hit with the maximum long-term capital gains rate of 20%. Not very bad when you compare it to the taxes you're paying for ordinary income, as well as for short-term gains. So yeah, this is the chart that shows the current federal tax rates for ordinary income or short-term gains. You can see it ranges between 10 to 37%. And I think most of you guys are going to be falling between 22 to 35%. So you immediately see why it makes sense for almost everyone to hold stocks longer than 1 year, because then that is when you're subject to that long-term capital gains tax rate versus this short-term / ordinary income taxable gains rate. That's why I always say long-term investing has really great advantages to it that I think a lot of people, sort of not realize. So if you're looking for the best way to file taxes while self-employed, I want to introduce you to TurboTax Self-Employed. They've been such a big help in letting me know what I can and can't deduct from my businesses, as well as taking care of my own taxes for many years. They make it super easy to file because I can just take a picture of my forms with my phone and it'll automatically upload all my tax information, so I don't have to worry about putting everything in manually. Now, as an entrepreneur with multiple businesses, I think TurboTax is honestly the perfect tax solution for independent contractors, freelancers, and small business owners, especially if you have 1099 income and want to take advantage of things like vehicle write-offs, home office, Schedule Cs, and maximizing industry-specific deductions. With TurboTax Live, you get unlimited access to tax experts who know your industry's taxes inside and out to help you file start to finish. Even if you're not ready to file yet, you can go to TurboTax for expert advice if you went through changes this last year, such as moving, getting a new job, or starting a new business. Especially with my cryptocurrency investments this year, I know I can file my taxes without worry because TurboTax Live can help me correctly report everything to the IRS. If you want to get the most out of your tax return, click my exclusive link in the description to start filing with TurboTax Live. That's basically how taxes work for stocks. Let's also now talk about taxes for crypto, which is pretty similar to that of stocks. Now with crypto, it gets a little bit more confusing because not a lot of people are aware of what taxable events are and non-taxable events. So same thing with crypto as stocks. If you hold for over 1 year, that's when things are taxed as long-term capital gains. And then when you hold for under 1 year, that's counted as ordinary income or short-term gains. So here's a list of things that count as taxable events. And we've broken it down into capital gains as well as income. For capital gains, we have things like selling crypto for cash, converting one crypto to another, as well as spending crypto to buy things or services. Anytime you do one of these things, you are actually realizing gains. And I think a lot of people actually don't realize that. Let's say, for example, you bought Bitcoin at $1,000. It's now worth, let's say, $30,000, so we have that gain of $29,000. If you convert that $30,000 of Bitcoin to $30,000 of Ethereum, that's actually a taxable event, and you are actually going to be owing taxes on that $29,000 gain, even though your money is still locked up in crypto. Now, some things that count as taxable income include getting paid in crypto, making any money from staking and mining, as well as any crypto interest payments. So yeah, when any of these things happen, these count as taxable events, and you will owe some type of tax. Now let's talk about non-taxable crypto events. Of course, if you just hold crypto and never sell it or do anything with it and just hold it in your wallet, that's not going to be a taxable event. If you gift crypto to other people or receive crypto gifts, that is not taxable. If you transfer between wallets and accounts, that's also not taxable. And of course, if you donate to charity, that is not a taxable event. So those are the basics that you guys need to know for taxes on crypto. Now let's sort of go back into stocks and focus more specifically on dividend payments. With how the stock market has been going recently, a lot of people are starting to focus their attention more on investing in dividend stocks, because these types of stocks sort of give you a more reliable return on investment with those dividend payments. And yeah, dividend payments are actually tax advantaged in certain situations. Shareholders get a preferential maximum tax rate of 20% on qualified dividends, but they do need to qualify. And in order to qualify, the company must reside in the US, or two, the company must reside in a country that has a double taxation treaty with the United States. Shareholders are going to benefit if they hold shares for at least 61 days during a 121-day period starting 60 days before the ex-dividend date. So yeah, in other words, there are advantages for holding dividend stocks longer than normal, because you will be able to benefit from the maximum tax rate of 20%. I will say that any days where the shareholders' risk of loss is diminished do not actually count towards that minimum holding period, right? So this includes things like put options and in the money call options. Now let's also talk about taxes for interest payments. A lot of you guys might have your money in an investment that pays out some interest payment. And yes, you will be taxed on that. Now it's pretty simple because the money you make from interest payments just count as ordinary taxable income. And this is paid at whatever marginal rate you are paying as an investor. And the only exception is interest on bonds that are issued by US states and municipalities. So now let's talk about about tax loss harvesting, which is a strategy that I think not a lot of people know about. If at least one stock in your portfolio drops below your cost basis, and cost basis just basically means the cost that you buy at, then the investor can actually sell that stock and realize capital losses and use that as a tax deduction. This tax deduction can be used for that same tax year, or it can be carried into the future for future tax years. So let's say you bought stock for $3,000 and you sold it for $2,000, right? So that means we have a net loss of $1,000. We can actually take that $1,000 of loss and use it as a deduction against your taxes for that year. I will say that there is a maximum of $3,000 that you can do this with, but anything in excess can actually be carried out into the future. So let's say you have a loss of, let's say $5,000 on a stock. This year you can take a $3,000 deduction, and then you can put that $2,000 that's remaining into the next year. When it comes to tax loss harvesting, you do need to be aware of the wash sale rule. So the sale and repurchase of substantially identical investments within 30 days, that counts as a wash sale, and it's disallowed if you take a capital loss in that current tax year. So in other words, let's say you sold that stock for $2,000, right? So you get that $1,000 loss, and you use tax loss harvesting to be able to deduct it from your taxes. Well, you can't actually get back into that stock for at least 31 days. So you can't sell it, realize that loss, and then the next day go out and buy it again. You have to wait a minimum of 31 days. Otherwise, it's called a wash sale, and it disallows you from actually taking that $1,000 deduction. However, if you're not taking that deduction, well, you can get in as soon as you want. So yeah, something that you should definitely be aware of. So now let's get into a really important part of the video, and that is tax efficient investing. We're going to go over the two types of investment accounts. We'll talk about taxable accounts, the pros and cons. We'll talk about tax advantage accounts, and we'll talk about the greatest tax efficient investing strategy. We'll also cover capital gains and tax efficiency, tax efficient investments versus tax exempt investments, and of course, securities that are better as taxable investments and securities that are better as tax advantage investments. So when you're investing, there are two types of investment accounts: taxable accounts and tax advantage accounts. Taxable accounts are just any sort of standard brokerage account that you open to buy stocks in, and a tax advantage account could be something like a Roth IRA or 401k. Now, each one has their pros and cons, but let's first talk about the pros and cons of taxable accounts. So for the pros, taxable accounts have fewer restrictions. They're more flexible, and they have more favorable tax rates for capital gains on long-term investments. Now, the cons are there are no tax benefits, and short-term investments are subject to that short-term gains, which basically just equates to your normal ordinary income tax brackets. Now, with tax advantage accounts, there are tax deferred accounts and tax exempt accounts. Deferred means to actually postpone, so you're basically just postponing that tax payment, and yet you're only having to pay taxes when you actually withdraw from that investment. You don't have to pay taxes up front, so this includes accounts such as a traditional IRA and a 401k. Right, with these accounts, you are putting in pre-tax money, meaning you do get a deduction for putting the money in there. That money can grow, but when you take it out, that's when you're actually taxed. Now, with a tax exempt account, the money you're putting into that account is actually after taxes. So in this case, these investments are able to grow tax-free, and you don't need to pay taxes when you pull it out. So examples of a tax-exempt account would be like a Roth IRA or a Roth 401k. With these, you get to put money into it, but this is money that's already post-tax, meaning you don't get a deduction. But of course, the benefit is that money grows tax-free, like I said, and when you pull the money out, you already paid taxes on it at the very start or with your contributions, so you don't need to pay taxes again. Now, the greatest strategy is to put specific types of investments in specific accounts. And basically, investments that lose less returns to taxes should go into taxable accounts, and investments that lose more returns to taxes should go into tax advantage accounts. Of course, this is easier said than done, but it is a great framework that you should have in mind when choosing which types of investments to put into what types of accounts. There's a relationship between capital gains and tax efficiency. So investments that trigger more capital gains are less tax efficient, and conversely, investments that trigger less capital gains are more tax efficient. So here's some examples of some tax efficient investments. The fewer capital gains you're paying, the more tax efficient it is. So this includes things like tax managed funds and ETFs. Now, of course, if you have more capital gains, this actually means you're less tax efficient. And this includes things like actively managed funds. Now, it's interesting because some types of investments aren't taxable at the federal, state, and/or local level. So for example, bonds, they aren't taxable at the federal level, and they're often tax exempt at the state and local level. Treasury bonds and Series 1 bonds, for example, are also exempt from state and local income taxes. So I'm not a financial advisor, but in a general sense, here is the rule you should be, sort of using when deciding what to put in your taxable accounts. You should put individual stocks that you plan to hold for at least 1 year, qualified dividend paying stocks, tax managed stock funds, index funds, ETFs, low turnover stock funds, and mutual funds. All these things make a little bit more sense when placed into your taxable accounts. Now, here are some of the types of investments you should put into your tax advantage accounts. Individual stocks that you plan to hold for less than a year, actively managed stock funds that generate large short-term capital gains, taxable bond funds, and real estate investment trusts. Sometimes it also makes sense to put a really risky investments into your tax advantage accounts. For example, look at Peter Thiel. He actually put a bunch of PayPal stock in his Roth IRA. Of course, he could not get a deduction when he put the money in, but that money grew substantially over the next few decades. And the great thing is he can actually pull out all that money, all those gains, tax-free. So as far as actionable steps, you guys, we went over a lot of the basics for investing taxes, but the truth is it gets really, really complicated and there's so much more to learn. I want you guys to think about what types of securities you're interested in investing in, and then think, which ones can I put in my taxable accounts and which ones should I put in my more tax advantage accounts. I encourage you guys to all begin trading with more awareness to how the taxes affect your investments. And if you do that in mind, you're going to be able to make a lot more money. So yeah, I hope you guys found this video helpful. If you guys did, make sure to hit that like button and also subscribe for more videos just like this. I make a ton of content about personal finance, investing, and entrepreneurship. Happy investing, and I'll see you in the next video. Peace.